How's it going, guys? My name is Jared Ace and welcome back to MoneyMetEish. On Monday, SATRIX announced the IPO of their newest ETF, the SATRIX MSCI India Feeder ETF. This ETF is very exciting because it gives South African retail investors the chance to invest in another Asian market in a Rand-based fund, which is also available in your tax-free savings account. The SATRIX India ETF tracks the MSCI India NET TR index by investing in the iShares MSCI India UCITS ETF. This is a feeder fund, so basically you invest your money in the SATRIX ETF, and SATRIX takes that money that you invested in their ETF and invests it in the iShares ETF, which is an ETF made up of 106 large and mid-cap Indian companies, encompassing around 85% of the total Indian equities universe. Today, we will have a look at what is happening in the country economically, and then have a look at a few more details about the ETF. But before we get started, please hit the like button, subscribe to the channel, and comment down below. Also, remember that my videos do not constitute financial advice and should not be used as the basis of any financial or investing decisions, as I am not a financial advisor, and these videos are meant for edutainment purposes only. So, let's have a look at India. India is the second most populous country on Earth with roughly 1.4 billion people. It has the sixth largest economy in the world in terms of GDP and the third largest in Asia behind China and Japan at $2.6 trillion. For context, South Africa's economy ranks 44th in the world at $366 billion. In terms of GDP purchasing power parity, India ranks third in the world behind China and the USA. However, with a nominal GDP per capita of $2,313, India ranks 145th in the world, only moving up to 122nd on a purchasing power parity basis, while South Africa has a nominal GDP per capita of $6,861, coming in at 89th place. It does drop, however, to 96th on a PPP basis. India is a member of the BRICS nations alongside Brazil, Russia, China, and of course South Africa, and its largest industries are textiles, chemicals, food processing and agriculture, financial services, and IT. The country's major industries are service and agriculture, with the latter being the largest employer, with some 40% of the population working in the agricultural space. The economy saw a decline of 7.25% in 2020, but showed signs of slowing as early as 2017. Last year saw 9.5% growth in the GDP, however, it is forecast to return to a more stable 6% within the next 2 or 3 years, with this year's growth projected to be 8.4%, according to the National Statistical Office. Don't be fooled by the decline on this graph, though. A 6% annual growth rate is extremely high. In fact, it's one of the fastest growing economies on the planet, roughly 3 times higher than most developed economies like the USA and Germany, and it puts our measly growth rate in South Africa of under 1% absolutely to shame. India has long been considered a sleeping giant, especially considering the size of its population. However, the country still faces many issues, such as relatively low levels of political stability, scoring 0.86 in the global rankings, putting it at 159th place in the world. It also has high rates of unemployment, relatively low scores on the Human Development Index, and more than a quarter of its population living in poverty. India also struggles with massive inequality, with a Gini coefficient between 74 and 82 as of 2020. Before the collapse of the Soviet Union, India had extremely restrictive laws governing businesses and was largely run by massive state-owned monopolies. When the Soviet Union collapsed, India lost its majority trading partner, which led to the threat of India possibly defaulting on its debts. The Indian government approached the IMF, or the International Monetary Fund, for a bailout loan in 1991, which came on the condition that the Indian government would liberalize the economy, which they did. India now has an ease of doing business score of 63rd in the world, putting it 21 places above South Africa, which ranks 84th. India's largest export partners are the United States, with the two being economic and military allies, the European Union, the UAE, and China. The largest import partners are largely the same countries mentioned before, with the addition of Saudi Arabia, from whom they get their oil. India is one of South Africa's biggest trading partners. They are our 6th largest export and 4th largest import partner. India has an inflation rate around 6%, and this has prompted the RBI, the Reserve Bank of India, to embark on a rate-raising campaign, although in India, it would appear that rates are played around with a little bit more than we're used to in South Africa. The RBI has only kept interest rates the same 9 times out of the last 57 meetings, with the longest period of no rate changes coming in 2017, which also coincided with the beginning of the slow decline in growth in the Indian economy. I feel like it's important to say that just because a company or an ETF is having an IPO doesn't mean that A, it's a good investment, or B, that you're getting it at a good price. The recent prices of companies like Rivian, which is now trading 30% below its IPO price, should be a reminder of this. However, this is not necessarily my thinking about this ETF, just a general reminder to research everything. SATRIX has released a brochure for the fund, linked below, and the ETF is a free float adjusted market cap weighted ETF, which will be adjusted on a quarterly basis. In simple terms, this means that the weighting of the companies that make up the fund will be determined by their market cap, which will be determined on a free float basis, which only takes the market cap of the shares available to the public into consideration and does not include shares held by promoters, company insiders, or government officials into account, leading to a lower market cap but a more accurate representation of the market movements and stock activities. These readjustments will be done every quarter or 4 times a year. The ETF will be investing in the iShares MSCI India UCITS ETF, which has returned 50.7% over the last 5 years, being beaten slightly by the SATRIX 40, which has returned 52% in that same time. Looking at the info provided on the iShares website, we can see that there have been 6 years of negative returns since 2008, the largest of which was the minus 64% return in 2008, coinciding with the global financial crisis of that year. We can also see that the India-specific ETF has beaten the emerging markets ETF 6 times out of the last 10 years. The 10 largest holdings in the index combined make up 45.9% of the index and are largely made up of financial institutions which should theoretically perform better in the high interest rate environment currently being created by the RBI's attempts to curb inflation. The index as a whole is composed mostly of financial, energy, and IT companies, with these 3 sectors making up roughly 55% of the index. The important dates to remember are the IPO opening date, which was actually the 31st of January, and you can currently buy letters of allocation or LAs from satrix.co.za or on EasyEquities under the new listing tab in either your ZAR account or your tax-free savings account. Remember though that even though 1 rand buys 1 letter of allocation, this does not mean you are paying 1 rand a share. There will be a conversion of letters of allocations to shares, with the ratio of the conversion being announced on Monday, the 21st of February, which is after the closing date of the IPO, which is midnight on Valentine's Day this year, or the 14th of February 2022. And the fund will be listed on the 24th of February. Finally, the fund has targeted a total expense ratio, or TER, of 0.82%. which makes it one of the most expensive on the JSE, especially considering that it is a passively managed fund, which is invested in another fund. It just seems a bit ridiculous, to be honest. It's a 40% markup on the price of the iShares India ETF, which it is investing in. You can also buy into the iShares India ETF directly on the EasyEquities platform in the USD account. You should definitely look at the pros and cons of investing in the SATRIX feeder versus the MSCI fund directly, and take possible taxes and conversion fees into account when making your decision. There is a chart provided by SATRIX in the brochure which would seemingly suggest that it is a better idea to invest in rands, since by looking at the chart, you can clearly see the rand returns are higher than the dollar returns. My initial thinking though is that this is most likely due more to the depreciation of the rand to the dollar over time than anything to do with the fund, and although investing in the iShares fund directly does offer a rand hedge, it also adds a further layer of complexity. The SATRIX fund can also be owned in your tax-free savings account, so you need to have a look at both of the funds very carefully before deciding. The fund you choose should be the one that gives you the best value. Should you decide to invest in this fund, you will also have access to one of the fastest growing economies in the world in rands, and possibly in your tax-free savings account. I really like how more and more South African ETF providers are giving South African retail investors access to more specific ETFs, be they industry or country specific. It really is great, and I wholeheartedly believe that South Africans should be more globally focused in terms of their investments. ETFs like these, although pricey now, are definitely a step in the right direction. Thanks for watching, guys. I did a 14-page write-up on the new SATRIX India Feeder ETF. You can find it in the description below. If you enjoyed this video, please hit the like button and subscribe to the channel for more videos just like this. Thanks again, and good night.